everyone, welcome to Fearfully Greedy. In today's videos I will do an update on the metallurgical coal mining sector. I did this same video on the 30th of March of 2021 and I wanted to check if things are the same. There's also Monish Pabrai who bought a couple of coal miners. One of them makes sense in this analysis, so we'll also take a look on that. Watch the first video because it goes a bit maybe more in depth, or maybe I say I'm more eloquent on that one. But remember that this video is only for metallurgical coal, the one used to make steel, and it disregards the thermal coal. And it's not that you sell to one or another. They are very structurally different with very different volatility, ash, and other contents. Okay, so only metallurgical coal. It's the one that we use here when we use a blast furnace to make steel, coal that becomes coke, and then it goes on the blast furnace. You use some coal also, or natural gas, in the when you recycle scrap steel. This is called electric arc furnace. If we compare the two methods, you will see that in one you use 780 kilos of coal for 1000 kilos of crude steel, where in the recycling one you use 150 kilograms of coal. The qualities in the results in both are different still. This is the percentage of the two methods. The blue one is the one using more coal, and the electric furnace or arc furnace is the orange one, where you see there is still quite a difference, but both have grown quite a bit. If we take a look from a World Steel Association, in the last year, the production was 71% BOF and 28% would be electric arc furnace. Okay, so the percentage is the same as when we made the video. The thesis on this video was also that the seaborne met coal, which is most of the coal miners we will analyze, is the one that is close to the sea, so we can ship it by ship, is very constant, so there are not many new viable projects by cost mainly. Also the consumption is pretty stable year after year, so we kind of can predict a lot what will happen in the next years. That's why I like this coal and I don't like the thermal coal, also for environmental reasons also. This graph was done in the first videos. In the video we already had it, and it was planned in 2019 or 2020. I tried to look more up, more for consumption. If we see, it's pretty constant from this up to 2021, so also a bit outdated. They think that the coal consumption will grow slightly in 2024, and here we see some moving up and down, where China in 2021 they thought it would go down, 2020 to 2021, but these are yearly movements. In general, if you see in 4 years, it doesn't change much, the consumption of coal. I found this graph. This is from Tech, which it goes through the thesis also, where we see this would be in the dark blue. We see the current supply of met coal seaborne for steel making, and on the gray we see the consumption. You always see there's a small disparity, right, even to 2050. This is also very far away. Technology could change. It hasn't changed for so many decades, but it could change. You never know with these things, but just if things keep as they are, there will be more depletions than new projects, and it will always be kind of a scarce kind of a mineral, right? Then the ones that we did the analysis in 2021, they were these ones. We have switched out Bale for the one that Monish bought, which is Alpha Metallurgical Resources. That's because Bale has exited the position, the operation, and they don't do it anymore. And Alpha Metallurgical Resources actually is one of the bigger US producers. We'll see if it's a good one or not, what he has bought, if we like it, or if we still like Warrior. Also, full disclosure, I'm invested in Warrior for the last 2.5, 3 years now. So take that into consideration when I do the analysis. Please do your own research, do your own numbers. This is not investment advice. I'm not an investment advisor to any of you. Okay. Also, what I explained in the first video is that I like to think it this way to maybe simplify. There will be the reserve, which would be the big water tank that you will pump water out, set it on tables, and sell it for a price. Okay. There are a few numbers that I think are important. 4 numbers mainly. One would be leaks cost. How much it costs you to take the water out from the tank, to take the coal out of the ground, right? And there are logistic costs and there are production costs. We should think about both if we're paying for both. If we get revenue for both, also we should take into account this logistic cost, which will be important at the end because geographic location is different for these miners. Then pipe size would be how much production and sales we can take out, how many millions of tons we take out a year from these mines. The bigger the production is good, but if we lose too many in production costs, if we pay a big price to take the coal out, it might be a worse operation, even if it's bigger per se. Water tank size would be the reserve. In this analysis, I taken into account proven and probable reserves, and not the mineral resources that they call it, which are inferred and they think they should be there, but they are lower on the list on what could be subtracted from the ground. And then the water quality ultimately is price. What are people paying for your coal? There are different qualities, different volatilities, different ash contents, different sulfur contents, and they have different uses in the market. The highest quality coal will be the hard coal, the low vol coal, and you will see that the price moves up and down. So it's not only water, not all water is paid the same, let's say, in this analysis. All these numbers I have taken out of 10Ks, 10Qs, company conversation, and company calls. I say this is my analysis, do your own. This analysis always came up from me trying to find a sector analysis that once I looked into it, it was thousands of euros, thousands of dollars, tens of thousands of dollars sometimes. And I did this in a few hours. So I don't know, take that into account. What numbers I have gotten. So I put the list of all the miners, and I got the percentage of profits from the last 4 years and the average, the sales from the last 4 years, the revenue from the last 4 years, and the average, this per ton, then the cost, this cost, and then cost per ton on the last 4 years and the average, and the difference between the two and the average, right? I think this gives us a very clear picture on what are the more or less costs of these operations, what are the volumes of these operations, and what are their clients willing to pay for this kind of coal. Then I subtracted the numbers that I think make more sense, because if sales are going down or they are trending up or they had a bad year for some reason, I tried to take that into account. Okay, for example, Warrior, which is the company I have followed most, in the last 2 years they have done much less sales, which have been very frothy years, so we have lost as shareholders a lot of money, right? That, well, it's still sitting underground, but the price has moved down a bit. But what I mean is that they have had a strike, other operations have had strikes, and the production was lower for that reason. But this year things have resumed to normal, so they will probably produce close to 7 million tons. And here I did the average cost per ton. In the first video, I think I did a mistake, or I have evolved a bit my thinking, that I take the cost, and if I saw it trending down, I would trend it down. But the thing is, I think you have to go year by year, because in years that you have a very high price, there are operations that then pay more to their workers, as they should. I'm not saying they shouldn't, but we should do average and average, because if they are trending down, because the price of coal is going down, the moment it goes up, it will go up. So we should do average and average, and then the margin ton average. Then expected operating income, or EBITDA, for the mining operation. Keep in mind, a lot of these companies, they mine many other things. They mine thermal coal, so this is the percentage. There are only 3 companies which are arguably only met coal, which is Ramaco, Warrior Met Coal, and then also the one from Monish, so Alpha Metallurgical Resources. Then I did enterprise value by this percentage, so we only want to take into account as if we could, but it's a way to do it. As if we could, this enterprise value only for the met coal operation divided by the expected operating income. Then in the middle in 2021, it was a rough year, so I was checking the free cash flow to see if anyone would go broke. I did take the same number, but not much to take into account. There are many capital expenditures in this kind of business, which are timely, oddly, or not perfectly. So this could move up and down a lot. But if you see in the last trailing 12 months, they have produced a lot of cash. Total reserve would be how many million tons of proven and probable reserves they have. This would be the expected life. Think that this moves up and down a lot. Adjacent mines might be acquired or getting rights to, but you don't want to see this number less than 10 because then you can count your days at that point. Also, if we see like GSW, which is not technically seaborne, but 85 years. That's a lot. It could be less. Also, accounting rules and norms are a bit different everywhere. So we want to see like we have a couple decades going on. Also, I want to make another. Well, I will make the point later. But the reserve value, we multiply this total reserve by the expected the margin per ton, and we get a reserve value. And then we divide the enterprise value by this to see how much are we paying for reserves. Okay, let's see what we did. On the first video, we did analysis for quality, which would be what's the margin on the last 4 years on average. We saw that Tech was number 1, BHP the second, South 32 the third, and Warrior, my investment, was only 5th. Okay, last one was Bale and Peabody. This year Peabody is still not the last one, but Tech is also still number 1. BHP has moved down a bit. Anglo American has pushed up. Okay, it's been a frothy market, so people have been gotten paid a lot. It was a tight supply market. Okay, so we see that Warrior stays 5th, but we see Alpha Metallurgical Resources from the one from Manish. I think it's a low quality kind of miner for met coal at least. Well, that's the only thing they do. So I'm not liking it for quality. Then we will see output. So we multiply that for the cells, and we got that BHP was bigger than Tech, and then Anglo American 3rd, and Warrior was pushing on 4th. This year, what we see is that Tech has, since they had such a wide margin, they do many less or a few less million tons, but it pushed above BHP. Then we have Anglo American 3rd, so it has stayed, the top 3 has stayed, but adding Alpha Metallurgical Resources, they have such a volume. They have 15 million tons of production. It's close to Tech, which is huge, right? So now it's the 4th, and this has displaced Warrior down, and GSW has also crept above Warrior because everyone has been getting paid a lot, and Warrior in a way has had one or maybe half a hand tied behind. Maybe they were losing like 25% output in this year, so they have hurt as they should in a strike. Then the last thing is we do by cheapness. So we divide it by the enterprise value adjusted for only met coal. The cheapest was Warrior at the time, then Arch Resources and Peabody 3rd. At this point, Peabody is the cheapest, GSW would be the 2nd cheapest, and Warrior would be the 3rd cheapest. Very close by, we see then like a multiple expansion, like by 2 the moment we go to Tech. But if you see, Tech is number 1 in everything, and it's top 5 in price. Close to these ones, but it's bonkers bonkers. It's ridiculous that you would pay 4.6 multiple, and then a 4.4 with Tech when you could buy the high quality miner in this way. And Tech probably has much more resources for the future. So I say this is not it says cheapness or value, but I'm not trying to analyze really like I'm not pricing this business. What I'm trying to see is if one is 2 times as cheap as another, and I like my Warrior met coal at this point. GSW is not really seaborne, it's in Poland. I've gotten burnt in Eastern Europe so far. Poland is another subject, but I wouldn't mind investing in Poland. But it's not seaborne. The quality of it, if we go by quality, like if we try GSW, if we go by quality, it has much lower margin than Warrior. If we go to BTU, like Peabody, the margin is tiny. It's cheap for a reason. And then I like Warrior Met Coal at that point. ARC would be cheap for a reason. Tech is ridiculous operation. They have best coal in the world probably. And then we have Ramaco, but if you see by this list, Alpha Metallurgical Resources, they are the bottom tier on quality. I would never buy it. Well, if it was half this price, maybe. No, more than half. It would have to be 3 times as cheap as now for me to buy it. But they had great years. Probably that's why Monish bought it, because if you see free cash flow in the last 12 months, they had a third of their enterprise value. So they had a ridiculous year. But the moment the market is normal, the moment that they don't get paid so frothy for this met coal that is scarce or tight supply, it's ridiculous. And even if we keep going this way into the future, I like Warrior better, because we get paid more and we are paying less for that thought margin. Then the only last point I want to make is that there's a customer distance. These operations are located around the world, and they have advantages depending where they are located. We have taken out Bale, who was in Africa, and if we see, we have the Australian coals that have advantage to Asia and maybe to India. GSW has advantage through Europe mainly. The Eastern American operations have advantage to Europe, and they also have a kind of advantage to South America. And Tech has advantage by itself to Asia, right? And very direct kind of shipping way. That's probably why they get also paid the most of. I found this graph, which I think it's cool to finish the video, where you see the volumes. Australia is still the biggest by a lot. They have so much coal there, so high quality coal. So for them, they are the highest exports in the world. United States is this tiny thing. Europe is not anymore this huge thing. It's more like a slowly declining. We're not the top of the world anymore, you know. The United States either, but United States has a few inline operations. They are not building so much. So, but in the future, maybe Africa sourcing, they can also source to Africa. So there will be necessity for steel for many years to come. That's a bit the conclusion of the video. Not much else. Other thing, if there have been a few changes in some of the numbers, is because they have adjusted reserves and resources, mainly for met coal. I mean, that's the one I follow the most, so that's why I know. But if you see, there's been a loss of like 50 million tons in what is reserves, proven reserves, or probable unproven reserves, and they have moved it to mineral resources, which is down the line. That's because these last resources, they are of lower quality. So the last 50 million tons, which they can mine also, they will be of lower quality to the ones we have been used for met coal, for Warrior met coal. As far as the portfolio, it has moved a lot in value, or quite a bit in value. We're at 41,700 euros. And Carvana is already the #1 position. We have multiplied by 5, so it just makes sense. It has pushed all the portfolio up. Naked Wines were still pending the report or news on it, so the valuation is very depressed. We have lost 66%, so quite a lot. There's also Interra Lietwa, which it's in bankruptcy. I don't know how to take it out, because I think it should be made at this point. If someone knows or what I should do, I don't want to just need to open another account or go to another broker. I would like, while we use the Giro, that it would match the Excel. So if someone knows, let me know. I have not bought anything, so very boring. But yeah, I've also started like a physical business project kind of. If it works, or if I think it's interesting, I will also bring it to the channel. Not give you all the details, but maybe the numbers and maybe sector or what we're doing. But yeah, another project that has taken some time for me. Okay. Let me show you also the Excel. The Excel says like this. I need to move this position up, but yeah, over 6,000 euros profit so far. So we're not in the red anymore. We hope I hope it will be for a while. Yeah, I have added over 900 euros every month since we started. It's been over 1,100 days, over 3 years. So it's been a while. I will keep bringing you new positions. For now, I'm reading a lot of theses, a lot of stocks, a lot of sectors, seeing what investors are buying, but nothing has piqued my interest as much as the current portfolio. So we'll stay with it. If something comes up, I will report back. Okay. Well, take care. Be safe. Thank you for watching. If you like it, give me a thumbs up, like the video, or subscribe. That also helps us grow the portfolio. Okay, be safe, take care, bye bye.